Hi, my name is Ariel Guerrero. This is going to be our presentation. Our team name is going to be Soulmates. We are Team E. The following co-managers are the following.
Hello, my name is Jacqueline Chacon Miranda, and we're excited to present to you all today.
Hello, my name is Ana Enriquez. Thank you for coming to our slideshow.
Hi, my name is Joanna Gaviria Villa, and I'm excited to be sharing this slide with you guys on this presentation. Thank you for coming.
Hello, my name is Shannon George. Thank you for joining us for our presentation.
Next, we will move on to the following slide. This is going to be our strategic vision. So our team Soulmates aspires to redefine the footwear landscape one sole at a time by offering a diverse range of high-quality shoes that cater to both athletic pursuits and fashion-forward preferences. Our commitment is to consistently deliver exceptional footwear choices that exceed our customers' expectations, establishing Soulmates as the ultimate destination for comfort, style, and value. On our next slide, we will go into our Year 11 strategic group map. Our initial competitive strategy was to be more focused, low-cost provider. You can see here on our diagram, we are going to be Team E. There's an arrow pointing to us. We kind of all stayed in the same realm for the first year. We did have a conservative approach. We weren't really ready to have these big high costs and expenses, so we reduced our cost where possible without sacrificing our quality. We wanted to make sure we had good quality products without having to break the bank the first year. Everyone kind of had the same idea the first year. You can tell we're all kind of bunched up together. There was a competitive edge, and then going forward after this year, we kind of saw everyone was in the same boat, kind of with the focused low-cost provider. Going into years 12, 13, and 14, we did change our strategy. In year 14, on the next slide, you can see we pretty much all shifted. We're not all grouped in together. So our year 14 strategic group map, our competitive strategy was to go for best cost provider. All of our strategies shifted. You can see some are to the right, some are to the left. We again are Team E. We have a little arrow pointing to us. Everyone shifted strategies to each corner of the graph. Overall, it helped our performance. Switching strategies, we started off our first year and we were in 8th, I believe, but switching our strategies and going forward, we bumped up to 5th place or 5th in our teams and our rankings. So I think switching our strategies was best for our team. So that way we can get a full understanding after looking at everyone's competitive strategies and what they were doing, what would benefit us particularly. The industry condition was still competitive. We still had some other teams that were right behind us kind of doing what we were doing, but I think overall switching to best cost provider would be best for our team. And on the next slide, we're going into net revenues.
In this slide, we will be discussing our net revenues and how our strategy affects the trends. So starting in year 10, we had a $432 million net revenue, but jumping to year 11, we had a significant change of $110 million. You can see our net revenues were $544 million to be exact. We stayed within our same low cost provider strategy where we were not ready to invest a lot in our company just yet. We wanted to get our feet wet and see how all of our competitors were going to be reacting to the first year of us putting our footwear out there. In year 12, you can see we had a dip of about 30 $5 million, and that is because we had not invested in new equipment, and we had kept it very conservative when it came to selling more shoes or having more shoes available. We also did not hit our investor expectations. Once we revisited years 11 and 12, all of our financial analysis for years 11 and 12, we noticed that our goal was to be hitting our investor expectations, meaning we wanted to hit net revenue expectations, earnings per share expectations, our credit rating and our image rating expectations. So we switched it up to focusing a lot on our low-cost provider strategy, but also not affecting the quality of shoes that we were offering. So we do see a huge significant jump in year 13, that we went from $510 million to $620 million. Very, very positive year for us. We kept that trend in year 13 going into year 14. It kind of dipped down a little bit. As you can see, we went from $620 million to $581 million because it seemed like a lot of our competitors were using the same strategy that we were. And what we did a little bit differently was invest heavily in our celebrity endorsements, which may have not been the best idea at the time, but it did overall help us get that credit rating and image rating up for us. So we can see that definitely in year 14, we still did pretty well, but we did not do as well as year 13. In this slide, we will be discussing our earnings per share and how our strategy affects the trends for our EPS. So as discussed in year 10, between year 10 and year 11, we wanted to stay very conservative. We were not ready to put ourselves out there, so we kept it very tight to the belt. And you can see that our EPS jumped slightly from $2 to $2.09. But between year 11 and year 12, when we started to invest more in our machinery and expanding into different areas of the continent or of the world, actually, we jumped from $2.09 to $2.63, which is extremely beneficial for our investors and even for our company, which also brought our credit rating significantly up. Between year 12 and year 13, we also see a very, very big jump from $2.63 to $5.51. And this is obviously because we kept our strategy, we kept our low cost strategy, and we invested in that strategy. And also we were able to still provide good quality shoes, and we met investor expectations, which is why we see that big significant jump from year 12 to year 13. In year 14, again, we see it kind of dips down a little bit, about $1.10, which is not that bad, but it was a small jump, or a small, I guess, decrease. And that was because our competitors were using the same strategy, and that's when we decided to revamp our strategy for the next 3 years going forward. This slide, we will be discussing the stock price and how our strategy has affected our price in general. And as you can see, there was a huge, from between year 10 and year 11, it stayed relatively the same. There was not much going on, just because we stayed with the same approach that we stayed for the first year, since we were trying to understand the market and the trends and the economies of scale. From year 11 to year 12, there's a slight increase, but not really. But then we do see the big increase in year 13, because that's when we felt very confident with our strategy, and we were also very confident in entering new markets and new segments, and our economies of scale was extremely strong. Again, in year 14, it dips a little bit, but still we were meeting investor expectation, and we kept positive with revenues and our image rating and credit rating. I'll hand this competitor analysis to our next member.
So we're going to talk about the competitor analysis part of these presentations. We realized after analyzing our internet segment for North America and the wholesale segment that our main competitors are GSL Corporation, FusionSoul, and Velcro and Go, which we are Team E, and this will be Team A and B and C. So these three competitors have been very consistent when it comes to coming up with the highest numbers and their strategy. It seems as something that we had to take into account in order to analyze what were they doing that maybe we are behind, and find a way for us to improve our strategy to move forward. In the next slide, we had the following conclusions about our competitor, and took this information and this data to improve or come up with how could we work in our part of our strategy and our decisions in order to be as competitive or at least be in the list, the first five groups. So we noticed that JSL Corporation has consistently been the leader in North America for both internet segments and the wholesale market as well. It has always had a strong presence, and even though we noticed that it doesn't have any market share in the private label segments. So this is something that kind of caught our attention, that even though it seems that they're not investing heavily in this, they are still able to have a big and strong presence as the main competitor against all of us. We also noticed that they do invest a lot in the SQ ratings. They invest a lot in their quality, and although we do try to keep the costs low, or the best cost now in this strategy, we do work to have good quality as well. But it seems that this competitor just really invests heavily in this, and has also the lowest or the shortest amount of time for delivery against all the competitors in this market. For the footwear, they deliver everything within 2 weeks. We also know for the wholesale pairs, we also noticed that they have excellent credit history. This is something that we were struggling with. So we, for our year decision, we were working on how could we improve our strategy. And one of those topics was our credit. So we made decisions based on how we could improve it, and our credit did improve. For FusionSoul as well, they have been very consistent with their numbers and how they can keep up a strong presence in the internet and the wholesale segments. They also do not have any market share in the private label segments. So this is something that might not be that important, whether you invest or not in the private label. We did invest in the private label, and we are actually pretty good in that segment, but this competitor does not. They also have pretty good quality ratings. The delivery time is longer, is 4 weeks for all the wholesale pairs, but although they take longer to deliver for their wholesale pairs, we also notice that they have the best image rating across all years. It's been very consistent. This is other topic that we had in mind when we were making our decisions, because we noticed our image rating was decreasing every year as we were making decisions to make our earnings per share higher. And and try to be, the best among competitors. So we also worked very hard to improve this, and it worked out in the end. And as well as a very good credit history, as I mentioned before, we took this into account. As you can see, all three competitors are very good with their credit history. Our credit history has never been bad. It's just that we always try to have it as good as possible when it comes to comparing with the rest of our main competitors. For Velcro and Go, is pretty much the same. We also, regarding their presence in the internet and wholesale markets, but this competitor has the most market share in private label segments. They do very, very well. They do invest heavily in this segment, and they have a 19.5% market share. They do, with their quality ratings are the most similar to ours. So they do pretty well in there, and their delivery time is more average. It's 3 weeks for the wholesale purse. Based on these, we made our decisions to improve our strategy. We took this into account. Our goal was not to copy our competitors, to see maybe by copying them we will do better. We just took into account what they are doing, to see what their actions were, in order for us to craft our strategy and see where we needed to improve in order to have better results. But we made our analysis and made decisions based on what we would think that worked for us, in order to improve in the ratings, or to even be better. And it wasn't too bad. I think we did pretty well, and we continue to be consistent, and we're hoping to just get better. Next slide, please.
Okay, so just real quick, we're going to touch on some forensics for some of the metrics that we charted along the way during this project. So starting with EPS, or earnings per share, basically the definition is the measure of a company's profit distributed to each share of its common stock. It helps investors and analysts to gauge the company's profitability and growth potential. Basic equation for EPS is the net income divided by the number of outstanding shares. Some drivers that we identify for EPS include net income, outstanding shares, share buybacks, dividends, revenue growth, operating efficiency, tax management, interest expenses, The most important driver that we identified for EPS was the operating efficiency. Basically, the impact of this on EPS is improved operating efficiency can lead to higher profit margins, and therefore subsequently higher EPS. In doing this, we increased our wholesale marketing and limited our model availability. Next slide. The next forensic checklist metric was ROE, or return on equity. Basic definition, ROE is the financial metric that measures the profitability of a company in relation to its shareholders' equity. It provides insight into how effectively a company utilizes shareholders' funds to generate profits. The basic equation for ROE is net income divided by average shareholders' equity. The drivers that we identified include net profit margin, asset turnover, financial leverage, share buybacks, dividend payout ratio, earnings retention, and effective tax rate. The most important driver for our team right now in terms of ROE was the asset turnover. Basically, the impact on ROE for asset turnover is the higher asset turnover generally leads to a higher ROE. We utilize that technique with brand advertising, model availability, and wholesale price. Slide. The next forensic checklist metric is stock price. The stock price is the current market value of a single share of a company's stock. It is determined by the supply and demand dynamics in the stock market and represents what investors are willing to pay for ownership in the company. The drivers of stock price that we identified include company earnings, market sentiment, economic conditions, dividends, interest rates, industry trends, company news and announcements, competitive landscape, macroeconomic factors, and market trends. The most important driver for our team for stock price that we identified was basically company earnings, and the company earning impact on stock price basically is positive earnings growth often leads to an increase in stock price. Slide.
Next, we're going to move on and go ahead and go into credit rating. A company's credit rating is an assessment of a company's creditworthiness, as well as it indicates its ability to meet financial obligations and its ability to be repaid debt. Credit ratings are assigned by rating agencies and are expressed through letter grades or symbols, with higher ratings reflecting a lower credit risk. The drivers include financial performance, leverage and debt levels, cash flow stability, debt service coverage, market conditions, management quality, industry position, credit history, legal and regulatory environments, as well as market perception. We have identified that the most important drivers for our team right now include leverage and debt levels. Our impact on our credit rating have the maintaining reduced debt levels and exercising careful leverage frequently leads to elevated credit ratings. So to the extent to which our company uses debts, including its loans and repayments, to finance its operation will highly impact that credit rating for us. And then lastly, we're going to move in to the last one, which is our image rating. The image rating refers to the public perception and reputation of a company. It reflects how the general public, customers, and stakeholders view and assess the overall image, credibility, trustworthiness of Soulmates. The drivers include product and service quality, customer satisfaction, corporate social responsibility, also known as CSR, brand reputation, transparency and integrity, employee relations, innovation and adaptability, financial stability, community engagement, media and public relations, and lastly, crisis management. The most important driver to our team right now is brand reputation, where a positive reputation contributes to a more favorable and higher image rating, as well as the perception and recognition of our company's brand is based highly on our brand advertising. And next slide, please. Next, we're going to move into our competitor strategy, which is going to focus on our 3-year look ahead plan and strategic plan. Our organizational goal is to have the company adopt a global best cost strategy. By adapting this hybrid strategy, we hope to get our most value for our money, where we offer both a significant competitive advantage while also attempting to maintain the best low cost compared to our competitors on a national level. We hope to offer differentiation in high quality materials, style and comfort in product performance, fashion forward athletic selection, as well as focusing on better advertisement through social media influences, as well as higher celebrity endorsements, which we had mentioned earlier. And finally, research on development with a focus on improved sole technologies.
To conclude these presentations, we also wanted to address the lessons learned throughout this exercise that we had regarding competing and the simulation game that was very, very insightful for us, particularly from a business perspective regarding the strategy and how that impact the overall business and operations specifically when you try to make decisions from the very beginning. We were very conservative in the beginning. It seems that we were too risk averse, and it's important to consider risk factors, and be okay with taking risks where we can see that it will make it better when it comes to having results that might be long-term more beneficial. As we were making decisions throughout the years, we realized that the concept of the higher the risk, the higher the reward could have played a very big role. And if we weren't so conservative, maybe we could have seen higher rewards and have higher amount of resources in order to play better throughout the remaining decisions. We also realized with this exercise here for this presentation, as we were going through our competitors, that we did analyze them, but not in such in depth that if we did it from the very beginning, maybe it would have been better for us to develop a strategy that would have allowed us to be more responsive to their actions, because you really don't know what the competitor is going to do and what their actions are going to be. But you can definitely try to plan ahead, assess the risks, and then make decisions that will be able to tackle those actions so you can just perform better. Overall, I think that we have been pretty consistent and we've done pretty well. Like it was explained in the beginning, before we started this simulation, all of our teams, I'm sure they're pretty competitive, and we're just been working very hard to make our decisions based on what we believe that Soulmates needs, and we are proud of what we have achieved, and we are also open for learning whatever is going to help us in the future for the future of Soulmates and our development as we become better in understanding strategies for business and operations. Thank you so much for joining us.